It's 7 a.m. You've got your coffee, you're rubbing the sleep out of your eyes, you unlock your phone and tap that little green icon, your brokerage app. You're expecting to see the usual, maybe a little up, maybe flat, and suddenly your stomach drops. You do the quick math in your head. I just lost 3 months of salary before I even brushed my teeth. You start spiraling. Is this 2008 all over again? Is my retirement gone? Should I sell everything right now and hide cash under the mattress? Stop. Take a breath. If you're watching this, the US market is bleeding. But before you hit that sell button and lock in a loss you can never recover, you need to understand why this is happening. Because in the stock market, panic is expensive, but knowledge is profitable. Today, we are breaking down exactly why the US market crashed, the three invisible bears turning behind the scenes, and why this might actually be the opportunity you've been waiting for. To understand a crash, we have to look at who organizes the party. In the US, that's the Federal Reserve. Imagine the economy as a college house party. When things are slow, the Fed brings out the punch bowl. This is low interest rates.
When rates are near zero, borrowing money is practically free. Companies borrow cheap money to expand. You borrow cheap money to buy a house. Tech startups with zero profit get billions in funding. This pumps the stock market up. Everything goes up. It feels like we are all geniuses. But here's the problem. The party got too wild. We got inflation. The price of eggs, gas, and rent skyrocketed. So the Fed has to take the punch bowl away. They raise interest rates. Suddenly, the free money is gone. Mortgages hit 7% or 8%. Credit card debt becomes suffocating. Companies stop growing and start firing. When interest rates go up, stock prices generally go down. It's gravity. The market crashed because the easy money era ended, and Wall Street is waking up with a massive hangover. They're repricing assets based on a reality where money actually costs something to borrow. But the Fed is only half the story. The second reason involves looking in the mirror. It's about valuation. During the boom times, we stopped caring about how much money a company actually makes. We only cared about the hype. We saw companies trading at 100 times their earnings. We saw JPEGs of rocks selling for millions of dollars. We saw EV companies with no cars on the road, valued higher than Ford and GM combined. This is the psychological cycle. When your neighbor makes $50,000 on a speculative tech stock, you get FOMO. You buy in at the top. This pushes prices to levels that make zero mathematical sense. The crash is simply gravity taking over. It's the market saying, okay, cool story, but how much profit do you actually make? When the answer is zero, the stock crashes 70%. When the answer is less than we thought, the stock crashes 20%.
The market didn't just break, it corrected. It's returning to the mean. Think of it like a rubber band that was stretched way too far. Eventually, it has to snap back. That snap, that's the red you see in your portfolio. So we have expensive money, rates, and we have expensive stocks, valuations. Usually, the market can handle one of these, but the thing that truly causes a crash, it's uncertainty. The stock market is essentially a giant prediction machine. It tries to guess what the world will look like in 6 months. The market hates bad news, but it can handle it. What the market cannot handle is no idea news. Will inflation stick around for 5 years? Will this geopolitical conflict spread? Will AI replace 20% of the workforce? When big institutional investors, the guys managing trillions of dollars for pensions, can't predict the next 6 months, they don't just wait and see. They sell. They move to cash. They move to gold. They run for safety. When everyone runs for the exit door at the exact same time, the building gets crushed. That is the liquidity crisis that turns a dip into a crash. Okay, I know, it sounds bad. Rates are up, valuations are resetting, and the world is chaotic. But I want to show you one chart that changes everything. This is the Black Monday crash of 1987. Felt like the end of the world. This is the dot-com bubble of 2000. Devastating. This is the great financial crisis of 2008. People lost homes. But look at the trend. Despite wars, pandemics, inflation, and crashes, the U.S. market has consistently moved up and to the right over the long term. A crash isn't a bug in the system, it's a feature. It washes out the bad companies, resets prices, and transfers wealth from the impatient to the patient. So, what do? Do not panic sell. If you sell now, you make the loss real. Dollar cost average. If you liked buying the S&P 500 when it was expensive, you should love buying it when it's on sale. Stay the course. Wealth is made in the bear markets. It's just realized in the bull markets. The market crashed because it needed to breathe. Let it breathe. Stick to your plan. If you found value in this breakdown and want to navigate this financial storm with me, hit that like button, it really helps the channel, and subscribe so you don't miss the next update. Thanks for watching, and I'll see you in the next one.